your benchmark Nifty valuations are very close to the 10-year average P which the Nifty has clocked over the last 10 years or thereabouts, but bond yields are nowhere close to their 10-year average. So how should one reconcile between these valuations, and is this going to lead to an extended period of consolidation or even a possible fall in the benchmark?
Yeah, right now what we are seeing is market moving lower and lower still, mainly because the U.S. interest rates continue to harden and the Fed is likely to hike rates again. And the U.S. currency yield supports a movement into U.S. dollars. And yet another factor is the geopolitical situation. It could get prolonged and there could be a flight to safety. And that is actually happening. And we have also seen overseas investors exiting the local markets. So these are some of the factors which have put some pressure on the local markets, and we expect it to continue. But the market would have plenty of support from three critical factors. One is the robust economic growth. Then the second thing is the rise in the public capex and the crowding in effect of the private capex. And third factor is that we have the local investments which are coming through the SIPs to the tune of about 16,000 crores. These are the factors which are gradually bringing the markets down, and this may continue for some more time. That is in sympathy with movements in the overseas markets, especially the US markets. If you look at the valuations and if you look at the 12 months trailing Nifty 50 average PE for the last 10 years, it's at 24. Whereas the current PE is at 22. Therefore, from a top-down perspective, specifically in the large cap space, the valuation doesn't appear that stretched, though there could be some isolated pockets of stretched valuations. If you look at the Nifty mid-cap 100 PE, it is close to 23, and it is more or less at par with the long-term averages. But where we see valuations becoming a little more expensive, or which is already expensive, is the small cap. PE has expanded quite substantially over the last 1 year, up from around 18.5 to 19 to currently around 24. That's as of September 23. So the small cap space has become more expensive compared to the other market caps, which large cap and mid caps, where the valuation is fair and it is sustainable. That's on the valuations. As far as the interest rates and the movements in the 10-year benchmark and interest rates is concerned, sure. India at this point of time has reached a different range for the 10-year yield itself, because we had seen 10-year yields upwards of 10% up to 14%. But because of normalization of the levels of inflation between the from 2 to 6% levels, the interest rates can actually stay much lower. That is why the 10-year yield, the bond yield, is around the levels at which they are around 7 to 7.5% levels.
Right.
So it's in there because of the lower inflation levels, or we can call it a better inflation parity and therefore a better interest rate parity with the overseas markets.
Right. I'll just take one more question. Very quickly, sir, if you can give us some context as to how should one differentiate between asset classes at the moment. So are equities at the top? Is it time to take money off the table, move to something more debt-like, something with regard to gold? Any views on that one? Very quickly, sir.
Yeah. See, when it comes to the relative attractiveness of the asset class, equities would rank the highest. But in individual investor portfolios, there could be investments which might have over the couple of years accumulated a lot of capital gains or profits. And in such situations where there is a lot of accumulated profits or capital gains, you could go in for booking of some capital gains or profits. That's advised. But otherwise, from a long-term investment perspective, From Emkay, our view is that the next 10 years is India's golden decade of growth. And this is the time one should remain invested in equities and equity funds. It could be equity AIFs or even very well managed portfolio management schemes. And this is the time to position the portfolio for the longer haul to remain invested in equities. And neither debt nor even real estate funds REITs or even gold would measure up to the performance of equities when you look at it from capitalizing on India's golden decade of growth. Therefore, equities would be the most preferred asset class. And at this point of time, as the market is trending lower and lower still, and where valuations look very attractive, whether it's banking and financial services or whether it is IT or whether it is the specialty chemicals, any of these sectors or even the pharma, we will see a major improvement in the price performance as we move ahead over the next 1 or 2 quarters, mainly on account of the fact that structurally the market's dependence on overseas liquidity has been brought down substantially because of the 16,000 crores of SIP monies, which is going to flow, continue to flow into the market.
Sure.
The second thing is that the US dollar is going to decline once the US interest rate hikes come to a halt, and therefore the dollar index could move down. And the manufacturing theme is something that's going to play out very well. These are the 3 factors which will make the equities extremely attractive, and the portfolio should be positioned for the longer haul, as this is going to be India's golden decade of growth.
Understood. Understood, sir. Thank you so much for